Good morning, I beg your pardon. Good afternoon, everybody, and welcome to the Audit Committee update. My name is Colin McDonald. I'm a partner and I lead our Boardroom program. Delighted to be joined this morning with someone who many of you know, Oliver Holt, who's a director in our financial reporting services team in Ireland. Oliver has been working with Accounting Technical since 1994 and joined us in Deloitte. Actually, seems like yesterday, but actually was 2007. So, Oliver, I know I call on you many times to support me in relation to the Boardroom program, so you're very welcome again. And in the interest of time, because I know there's a lot of areas you want to cover off this morning, I'll pass over to you.
Thanks very much, Collie. And do feel free, yourself and indeed all participants on the call, to just interrupt or whatever with any comments that you may have. We have quite an extensive agenda. Going to look at some hot topics that I see around boardrooms at the moment, some trends that I see emerging. And also top of mind is getting ready for reporting on calendar 2025 for those of you who've got calendar year ends. And within that, looking in particular at accounting standards, corporate governance, and sustainability, with a concentration on what might be new and where there might be some key areas of challenge that you might want to bring into the audit committee with you to ensure that management are thinking about all these changes and have them appropriately lined up, both for you as a member of an audit committee, but also to reflect the activities of the company that you're directing on. There's quite a lot of material here, so welcome any interruptions in terms of any observations or questions as we progress through, whether it's from you as a participant or indeed from either Ruth or Colin, just to keep us all on our toes and interested. So looking at the hot topics that are in front of board committees at the moment, there's a variety of them, and this is just a small selection that I've picked out, mainly because I see them recurring and coming up time and time again. Using language like market dynamics to pick up on a huge range of things that are happening out there that come in front of the audit committee, and the audit committee starts thinking, well, kind of what are all the implications of this? Top right hand side there, you see we talk about reporting, assurance, controls and risk, which I'd regard as the bread and butter of the audit committee. But as things happen out in the market, as we see Trump, then we hear TACO, and then we hear tariffs, and then we see withdrawal from Pillar 2, and then all U-turns, and then maybe not U-turns, and U-turns on U-turns. The whole fact that it's getting so difficult to actually forecast, simply because the goalposts keep on moving, but also because people are noticing that trends that they identified previously in their marketplace are actually accelerating. And things that you thought might happen 2-3 years out are actually beginning to happen very substantially now, or have happened, and very hard to keep pace with that and to make sure the model keeps pace. And then from all of that, the reporting, the assurance, the controls and the risks. And that's keeping an awful lot of committees pretty busy at the moment. We're also seeing technology as a topic coming out. As we saw in our 9 o'clock news just last night, Dublin Airport hit by a cyber attack. And those cyber attack and that whole area of cyber, and in particular the risks and controls around it, are coming much more to the fore in audit committees. And indeed, the difficulties with cyber are becoming more and more apparent. And in particular, the whole notion moving from you're not under cyber attack to what is the degree of cyber attack you're currently suffering, and can you actually now get to a position where you have to admit yourself that we actually haven't got sufficient controls or sufficient ability to stop the cyber attack from happening or occurring, or for them to get in, but that on the assumption that they're already in the systems, how can we actually corral them and keep them away from anything important? And that has become much more of a focus. And indeed, there was a recent cybersecurity conference in Singapore, And during the course of that conference, all these specialists in cyber and preventing cyber, all in a room, and then some of them noticed that they were invited by way of QR code to find a way of skipping various different queues into various different sub-events that were being run. And even these cybersecurity experts failed to spot the clues that the QR code was actually intended to be, in a white hat way, malicious and wasn't meant to be a proper code at all. And an awful lot of them fell for it, which shows the main difficulty that there is and the main risk that's been identified in technology, which is simply ourselves and our human behavior. And that becomes very difficult for the audit committee to find a pathway through all those various risks as what they should be doing. And we'll talk about artificial intelligence in a moment. And underneath technology, I have fraud. And that whole area of artificial intelligence and it been used to help execute frauds is also one of huge concern. Another hot topic that I'm seeing is outsourcing and where an organization has done outsourcing, how it actually embeds its own corporate governance into the outsourcer and how it makes sure that it has the same level of controls as in its own organization. And indeed, as information starts to trickle out as to what happened for the recent cyber attack, we can see that a lot of that was driven by what actually happened in an outsourcer rather than actually the airlines themselves. So that's becoming very much more front of mind for the audit committee as to how do we achieve that same degree of control and make sure the outsourcer is not the weakest link. Sustainability hasn't gone away and is still a topic, and I will talk a little bit more about some recent developments in sustainability. But that is something that we're seeing more coming to the fore in terms of the audit committee being asked what are the controls around sustainability, what level of assurance are we getting over our sustainability information, and exactly how are we reporting on it, and are we reporting in accordance with the appropriate standards. Fraud never goes away as a hot topic, so it's got right place on this slide, as you would expect. As I mentioned, artificial intelligence is making it more and more difficult to detect fraud, but it remains something that keeps coming up at audit committee level. Interestingly, as you know, a number of audit committees will have ensured that there's been whistleblowing and the development of hotlines and all that sort of stuff. And I think it's now kind of clear that some of that whistleblowing isn't actually doing what was originally intended and seems to be more a gripe line for employee gripes rather than being a source of information as intended to prevent financial reporting and other types of fraud. And then in a number of audit committees, we're seeing a lot of concentration on the change that's forthcoming in the UK Corporate Governance Code, where provision 29 will require a declaration on internal controls. And I'll touch on that a little bit later. There are also a number of trends that are apparent if I look back over the last couple of years. Clearly, the expanding remit of the audit committee continues apace. Even when we're talking about hot topics there, a lot of those hot topics don't fall into what you'd regard as the ordinary bread and butter, being reporting and controls over reporting that you might expect to see in an audit committee. And indeed, a lot of audit committees have tried to address this by rebranding themselves. The Risk and Audit Committee or something similar. But even that rebranding doesn't go far enough to actually capture what we're seeing as the general remit that's falling into audit committees at the moment. And that puts an awful lot of pressure back, and I'm going to say us because I am a member of an audit committee, an awful lot of pressure back in terms of how do we ourselves keep ourselves up to speed in terms of everything that we need to know for discharging our duties on the audit committee. And that remit mentioned sustainability on the previous slides, artificial intelligence, even cyber and so forth, all of it becoming an awful lot more difficult to deal with. The artificial intelligence piece, like you've got to get into the nitty gritty of this. being able to understand the difference between all the various different types of artificial intelligence out there, whether you're looking at generative AI or you're looking at some other piece that AI is trying to achieve, and exactly how does that impact on your business. And indeed, in recent times, it's become very clear that if staff are left uncorralled and there is no policy to address artificial intelligence, then there is a high risk that information that's protected under GDPR gets put into one of these artificial intelligence engines. The engine has no boundary around it, and next thing you do not know, where data that you should have had protected within your organization under GDPR, where it's actually gone within the cyber world. And that's concentrated a lot of minds and a lot of audit committees in terms of how do we actually get in the guardrails to make sure that data stays within the organization that ought to stay within the organization, but at the same time develop a sufficiently robust artificial intelligence policy with all the controls and assurance required within it, that best benefit has been made out of it. And in a very business-driven way, if there is to be investment in artificial intelligence, that there's sufficient control around that investment, that there's actually very much a positive return for that. That brings me on to another trend, which is in terms of meetings, that a bit like we are at the moment, meeting over Teams and Zoom and so forth. Plenty of that to be seen. But apart from the format, and there is more movement back towards being in person, apart from that movement, there is a lot of difference in kind of even the style or organizing of meetings that we're seeing now. Because of that expanding remit and because of needing a deeper understanding of something like artificial intelligence, we're now seeing meetings, if you like, training sessions being organized where there's a deeper dive into a single topic, or we're seeing other ways of trying to achieve the work of the committee because, frankly, meetings are getting extremely long for what's needed to be covered, and there has to be other ways to make it much more digestible. That leads me on to something that's beginning to emerge as a trend in terms of a cross-committee dynamic. That was always there, but it's seen now as being much more important that there's a greater fluidity between the various different committees, both in terms of information sharing, thought process sharing, and overall direction, so that the business can be achieved much more efficiently and effectively. We're also seeing a demand coming through for the audit committee, not only to give the oversight through the business and its controls and assurance that it was always there, but now to have a little bit more foresight and to also bring to the board table that ability to see around corners, to see things that are emerging and to see things that are coming. Artificial intelligence been, one particular point of focus in that. And then finally, just in terms of all the trends that are out there, just one more that I will say for this morning is in terms of succession. We're seeing it a lot more difficult to actually hold on to people, and regardless of, for example, the offering or salary offering or indeed opportunities are there. It's just very, very difficult to hold on to people, and that's becoming more and more of a concern at audit committee level as it becomes more difficult to see that various different grades within the finance team, how they are staying and what is the succession plan for all the various different grades in the finance team becoming much more of a point of focus, as it is the same in internal audit in terms of holding on to the internal auditor and indeed the number 2 and number 3 within that department. That whole area of just holding on to staff and getting the best out of them has become much more of a topic that needs addressing at audit committee level. And then finally, one chestnut of a trend, which I think that we'd all agree with, which is just simply the volume is just growing. And this is perhaps the case with all board papers in their entirety. This came through my LinkedIn, and I just thought it might be appropriate just to share it. This is from 1982. Where David Ogilvy was writing just to his staff generally as to how you might write better. And as you can see from the second line there, people who think well, write well. And so there's an awful lot of this that's motherhood and that you can't argue with. But I thought the very last point was that if you want action, don't write. Go and tell the guy what you want. And I suppose in the audit committee, if we have the CFO or the internal auditor or whoever in the room, well, it saves us writing. But I thought it might be useful to share this with you, because if you do, like me, come across the paper that could have been an email or could have been a two-liner or whatever, it might just be a good thing to see if there's possibility of getting management to think about the board papers again, and how things might be reduced to one A4 size paper or whatever, to allow the business to proceed as smoothly as it can. So I've talked a bit about the trends and highlighting some key topics that are coming up at various different audit committees, and hopefully none of that is any great news to you, but maybe give you a little bit of insight and maybe point a little bit towards what you might think for your own audit committee. One of the jobs that's not gone away is that we have to get ready and help management get ready for reporting in 2025. I don't have an awful lot to say that's new for 2025, which is good in its own way. There's this small amendment to the standard on foreign exchange, which shouldn't apply across the board, but only in circumstances where you're dealing in a foreign currency that it's hard to get an exchange rate for. So that means that you're dealing perhaps in the southern half of the globe rather than the northern half. So that shouldn't only crop up in some very large multinationals, and I'm sure their finance teams are all over that. One thing as an audit committee member to be aware of is that in addition to having all those IFRS standards, there is an interpretations group out there known as the IFRIC, the International Financial Reporting Interpretations Committee. And the reason why I'm talking about this is because in recent years, we've noted a number of different reporting entities that had to take a prior year adjustment because the Interpretations Committee had said something in what they call an agenda decision. And the agenda decision pointed to how the standard, as it was currently written, should actually be applied. But they hadn't picked up on the agenda decision. And then that meant that because a couple of reporting periods passed since the agenda decision came out, they needed a prior year adjustment to get their accounting policy back in line to how the Interpretations Committee said things ought to be interpreted. So I'm just showing you from volumes 11 and 12 some key agenda decisions that are there, and at the bottom of the slide, and linking you off to where there are a few decisions in the pipeline. So kind of from an audit committee point of view, you don't need to know the nth degree of everything that's going on within these decisions, but you do need to know enough to be able to say to the CFO, has the report taken on board the IFRIC agenda decisions, and in particular the most recent ones. And the reason why I suggest you keep the challenge, if you like, very general, and which goes in the middle of the slide there, you see I've given you a link to all the agenda decisions by date, because there are a lot of them, is because if the finance team have missed any of the past ones, that's where the nasty surprise might be, and where there might be a need to relook at things. And the quicker that's spotted and early, well, we're now getting ready for the reporting season, that's spotted, the more that we can do something about. So just to draw your attention to those things and to make sure that management are actually keeping an eye on these and making sure that they're reacting appropriately. There are a couple of new standards coming through for 2026 and beyond. Won't talk about any of them in any great detail. I will leave you with the detail here. Just to say that if you want to get to know a little bit more about any of the changes that you see coming through from 1 January 2026 for financial periods commencing on or after 1 January 2026, the little green boxes, they're all live when Ruth sends you this deck, and you'll be able to click into those. They'll bring up a need to know document from Deloitte that'll actually give you enough detail around the standard to let you know, is there something here that I should be challenging management on the next time they put a financial report in front of me. The middle one there, contracts referencing nature-dependent electricity, that's definitely one to have a read of if management have been entering into green electricity deals and are putting assertions in the financial statements that all electricity or most electricity being used as green electricity, and then the accounting around for all of that sort of thing. I've got a couple of slides here that go into the requirements and the details. Won't talk you through all of that. That's if you need to know it, by all means have a read of it, or indeed share with management to make sure that they have picked up on all the detail there. But your challenge being, have they actually looked at it, and are they what you call it, up to speed with all of that? That contract on nature-dependent electricity is available for early adoption. In terms of new standards for accounting periods commencing on or after 1 January 2027, we've two new accounting standards yet to be endorsed for EU. That's IFRS 18, which will change the look of the profit and loss account for IFRS reporters, and a few does a little bit more as well than that. And also IFRS 19, which is introducing a disclosure reduction regime for subsidiaries that do not have public accountability. It's FRS 101, but not as you understand it. It takes a very different approach to how FRS 101 applies to financial statements. In IFRS 19, the ISB are building all the disclosures up from the ground up, whereas under FRS 101, it was, you've done your IFRS set of accounts, now here's what you take out to get to an FRS 101 set of accounts. So very different approach to things. So I suspect most reporters who are on FRS 101 are content enough with that and won't change. But everybody will have to look at IFRS 18. And I will come back to what we might think about in terms of preparing for IFRS 18 in a moment when I talk about IASA. Also to say that the ISB are working on some illustrative examples of how IS 37 on provisions deals with uncertainties, and uncertainties in particular in relation to climate and reporting on climate. They've had a project ongoing for a while, and they're now published a near final draft of 6 examples. I'll give you a link to it there on the slide with the final document to issue at the end of October. Now, as IS 37 is already in effect, and this is adding examples to IS 37, that means that in effect these examples will be effective on publication. And really what they're trying to do is illustrate how the principles of IS 37 are applied to uncertainties. So the challenge from you is during the preparation of the 2025 set of financial statements to ask management, have you looked at these illustrative examples and how do they apply and how have you applied them in arriving at the financial statements? And in particular, if you get pushback from management, just simply say, well, they're just climate and climate isn't a big deal for us, or we're looking at climate some other way. The pushback is, well, they're actually not just to look at climate, they're actually illustrating the principles of IS 37, regardless of what the uncertainty is. So for all their uncertainties, have you looked at these examples? Have you seen how they apply to us? And has it been applied appropriately? And again, you may want to dip and dive into 1 or 2 of these examples, just to give yourself the assurance that management are applying it to the circumstances that you find on your audit committee. I mentioned FRS 101. This slide is just telling you where we stand in relation to FRS 101 for the reporting season that's coming. So we're basically looking at the 2022 version of FRS 101 with additional disclosure exemptions for Pillar 2, comparative information about the right to use of assets. So that's put it on the same basis as the comparatives for PP&E. You don't have to show that movement. So the comparative movement is out. The balances are still there, but the movement is out. And then conditional exemption in relation to certain items around IS 7. And there's an annual review that I'll leave the rest of that material for you to work through yourself. But again, just making sure that management are aware that FRS 101 does get an annual update and that they are picking up on the right pieces of FRS 101 if they're putting a set of statutory accounts prepared under FRS 101 in front of you to tell the board that it is okay to approve them. If you're in the FRS 102 world, again, you're looking at the current edition being the January 2022, plus the Pillar 2 amendment, plus for 2025 supplier finance arrangement disclosures. We got those last year in the IFRS world, and this is the Me Too version of them in the FRS 102 world. So if you're in an organization reporting under FRS 102 and there are arrangements with your suppliers to help finance them, then those disclosures need picking up on. Also, the last bullet there, just to let you know that the FRC have produced certain staff fact sheets to explain better how FRS 102 should be applied in various different circumstances and various different aspects of FRS 102. And again, your challenge to management is, are you aware of the fact sheets? Have you applied them? What's changed or what ought to change as a result of what the FRC are telling us FRS 102 is to be applied in that way. Number of other matters just to draw your attention to, and again, it's the same sort of idea in terms of saying to management, are you aware of these things? Have you done enough in relation to our reporting? There's over 42 thematic reviews on the website, the FRC's website, covering all sorts of different aspects of financial reporting that you will want your company to have got right. The most recent one, funnily enough, that I'm going to draw your attention to is a year old at this stage, which is offsetting in financial statements. So this is when can you set off two different numbers or net down two different numbers. And funnily enough, the accounting standards are fairly strict in terms of what can be offset and what can't be. And again, it's a good challenge to management to make sure that the numbers that ought to be gross in your financial statements are shown and presented as gross, as opposed to those that ought to be netted and ought to be presented as net. We've also seen a little bit of movement in terms of guidance around the whole going concern. So if going concern is not clear cut for your organisation, would certainly recommend you pointing management towards these and making sure that all aspects of that guidance has been picked up. One other corporate reporting supervisor that we need to keep an eye on these islands is IASA, and I give you a list there of what they've published in the last 12 months. You can see their most recent publication at the top of the list there is on sustainability linked financing. So they did a desktop examination of the main companies on the Irish Stock Exchange, equity listed companies, looking at what they disclosed in relation to their borrowings, where those borrowings had terms and conditions that were, if you like, green or linked to sustainability. And they had quite a lot to say in relation to whether they would all be IFRS reporters, whether IFRS 7 in this instance had been fully complied with. But there's a lot of detail in this, but there's a general overall thrust that not enough has been said about the terms and conditions that are green and what those green terms and conditions mean in terms of repayment, in terms of renewing loans going forward, or indeed in terms of interest rate, with IASA with some guidance there in relation to what should be said. So again, if you have green bonds or you have financing from various bankers or others that have conditions attaching to them that you say that you will meet certain sustainability criteria, again, very good to challenge management in relation to, have you taken on board everything that IFRS 7 would require in those circumstances, and in particular as illustrated in this September document that has come from IASA. One thing, and I'm going to advertise an IASA event now, if you bear with me. If you look at the green box at the end of the slide, every year IASA do an audit committee briefing. It's going to be both in person and online. So whichever mode you choose, I'll give you a link there to register. It's on Wednesday, 22nd of October, so about exactly a month away, where IASA will bring us through, if you like, some of the key topics and some of the things that I've probably mentioned here today, and give us their particular supervisory slant on all of that, and always very worthwhile hearing, and it's always a very good event. So I do recommend that if you can fit it into your schedule, that you certainly think about it. There will always be, I suspect, a recording on the IASA website, so you'll be able to pick up on it at a later stage. IASA have produced quite an amount over the year in terms of speaking of its own activities and so forth. And I think it's always of interest to see what are the issues that IASA have to tackle the most frequently with the financial statements that they review. And we can see from the slide here, they've discovered and they've disclosed their top 5 and compared it to 2023. So we can see the Transparency Directive regulations, IFRS 7 and IFRS 9 of financial instruments, the presentation of financial statements, alternative performance measures or KPIs being reported on, and then segmental reporting under IFRS 8 are all the sort of things that come up time and time again with anybody who's got either equity or debt listed on the Irish Stock Exchange, Euronext Dublin. So if you're on any of those audit committees, again, challenge to management is to make sure that these particular areas have received due attention and that at least anything IASA has reported on publicly is not something that they're going to be talking to you privately about. Just a quick reminder on company by company reporting. This applied for financial years beginning on or after 22nd of June 2024. So we've got to make sure that these particular obligations, which is the disclosure of income tax information for certain companies, is done from 1 year to the next. So again, that might be something that you need to add to the list of what you have to prepare for if you fall within scope of that particular requirement. In terms of what's going on in the wider world and what we've seen as trends within financial reports, we have to our UK firm corporate reporting insights. They're all theme based. I'll give you a link at the top of the slide there for where you can sign up to get these into your inbox if you wish. So we've looked at controls and assurance and climate related reporting, and we're about to publish in relation to artificial intelligence and how that's been impacting on the FTSE 350 annual reports. And for comparisons, because all good accountants want a comparative, I give you our reporting insights that we published last year at the bottom half of the slide. Again, all these links will be live when Ruth sends you the deck. I also commend this particular publication to you if you're not getting it already to look at our IS Plus website. Again, the green box and the links on the slides will all be live. This is a very useful document in that it covers off on all the things I've been discussing this morning and more besides. Now, it does have a UK slant because it is written by Deloitte UK, but a lot of it transfers very quickly and without much change into the Irish environment. And it will keep you up to date as to what is happening in the whole corporate reporting world. So I commend that publication to you. We update it quite frequently, not quite monthly, but it does get updated every couple of months, and well worthwhile keeping an eye out for it. Colin would be very disappointed with me if I didn't mention IS Plus at least once during the course of these sessions. So here's my mention, and again, great way of keeping up to date. My big reveal for Colin is that not only is it on a website that you can get in your desktop or whatever, but we actually now have it in a mobile app version where you can go to the App Store either for an iPhone or an Android, and I've given you a link there in the box on the left-hand side, and actually download a mobile version of the IS Plus whole system to your mobile phone. So it's much more than just a website that's just been downloaded and made something that your telephone screen can read. This is actually an app itself in its own right. So if you want to never be without access to IS Plus and you need to have it on your phone constantly, we now provide you with that facility. Okay, I mentioned that I was going to also talk about corporate governance changes in terms of what preparing for our 2025 reporting. Now, as we know, the UK Corporate Governance Code has been updated, published in January 2024. Its effective date has been for accounting periods commencing on or after 1 January 2025, but excluding giving a declaration on internal controls, and consequently then for reporting periods commencing on or after 1 January 2026, it'll be the new UK Corporate Governance Code plus the declaration required by provision 29. To give you a flavour, here are the key changes between the UK Code of 2018, which has been applied by Irish companies up until 31 December 2024. For 31 December 2025, of course, Irish companies that apply the UK Code will have to move on to the 2024 version of the code. I won't talk through all the sections here. I'll leave them there for completeness because as an audit committee, we're focused on the audit committee, though as board members, clearly we're interested in the entirety of the code, hence me leaving it all there for completeness. But we can see in terms of the key changes and emphasising that it's for accounting periods commencing on or after 1 January 2026, is the new provision 29, requiring the board to monitor the company's risk management and internal control framework, and framework being new language here. To do that at least annually, carry out a review of the effectiveness. The monitoring and review cover all material controls, so not just financial controls, all material controls, including financial operation, reporting and compliance. And the board should then provide in the annual report a description of how the board has monitored and reviewed the effectiveness of the framework. So that's covering both risk management and internal control. A declaration of the effectiveness of the material controls at the balance sheet date, and a description of any material controls which have not operated effectively at the balance sheet date, the action taken or proposed to improve them, and any action taken to address previously reported issues. So you can see the code provision is quite an extensive one. And if we compare it with what was there before, which we should do then in a moment, you can see that the old provision 29, which we're still reporting against at the minute and for 2025, was very short. And I've highlighted and read the words that have changed, if you like, when you look over in provision 29 for the 2024 code. So the risk management and internal control systems have now become a framework. And we see the addition of reporting controls to the list of controls that are to be reviewed. And then we see a much more detailed list of 3 bullets requiring what should go in the annual report, including in the second bullet there, a declaration of the effectiveness of the material controls at the balance sheet date. So a very, very different and tougher regime. I know that some commentators in the UK originally referred to this as being Sarbox Light, being a reference to the Sarbanes-Oxley framework in the US. And of course, in the US, we see Donald Trump already announcing that he doesn't think quarterly reporting is a good thing. Maybe that could be because the impacts of tariffs are starting to show through in the current quarter, and he'd prefer to remove that reporting. Who knows? But nonetheless, this is not Sarbanes-Oxley by any manner or means. For starters, Sarbanes-Oxley is only concerned with financial controls, whereas this declaration is concerned with all material controls, not only in the financial area, but those that include operational compliance and reporting controls. So in a way, the UK declaration is much broader than just a narrower financial piece. And also, as you know, Sarbanes-Oxley brought with it a massive overhead in terms of testing and so forth. And there is no talk here in provision 29 about auditors' involvement, but we will come on to that now in a moment. So if you're preparing for the new provision, you do need to make sure that everybody is updated and knows what's required. You've already got particular governance structures and processes in place, and the question is, what's the gap and what do you need to further utilise and build out on to get to a position where this declaration on the material controls can be done? Because if at the moment in the audit committee the complete focus has just been on financial controls, that focus on financial controls now needs to broaden into the material controls and the identification of the material controls. So there's a question of the risk management internal control framework. How much does that need to be reviewed and enhanced? What's the process that's going to be gone through to actually identify these material controls across the business and throughout the group, and for meeting this provision 29 purposes? And of course, I think the sensible thing to do is to build into the timetable, because we have until January 2026 a dry run of the entire process that needs to be gone through during the 2026 reporting cycle. So you're looking at getting a number of building blocks together to get a dry run. Definition of material controls, how you're going to measure effectiveness, where is the assurance coming on all of this, what is the board's role in terms of the monitoring and review and so forth. And you can see in the box below where I'm identifying a number of different areas where you're going to look for confirmation or identify the issues. So clearly, what's your population of material controls? You don't want that to be so enormous that you can't actually deal with it. So that definition of what's material control and having it across the patch. So you can't just confine yourself to financial controls. And how do you and who's going to do the work of setting those boundaries of how you identify what is a material control. So what does count as a control not operating effectively, given that there can be a lot of things that can compensate for one control not working. Your sufficiency of evidence to support everything you're doing, along with the sufficiency of documentation, and how do you get your auditors comfortable, and what's actually necessary to get the auditors comfortable regarding the declaration of controls, particularly in the area of financial controls, which, as you may imagine, is something that the auditors will have been looking at as part of the job you've given them to do in terms of reporting on your statutory financial statements. And then you need to look at the actual disclosure itself, its wording, and does it do the job of actually saying what's been done and the conclusions to be taken from what's been done. So if you look at the reporting, I give you one example on the left, which probably actually doesn't meet what's required, and then the example on the right, which gets into a lot more detail about what's been done to try and make it easy and clear for the reader to actually see what the declaration actually means, the boundaries of that declaration, and what has been done to support it. And then you have the auditor and the auditor's role in all of this. And as I mentioned, Provision 29 doesn't say anything specific for the auditor and doesn't put any new responsibility on the auditor. But as you will know, auditing standards do require the auditor to look at the entirety of the annual report and put a responsibility on the auditor to make sure that anything that's in the annual report that's over and above the financial statements is to look at that, to read that information and to make sure it's materially consistent with their knowledge from the auditor. And as you can imagine, assessing the strength and the working of internal financial controls is within scope of what the auditor will be looking at. So they will therefore have a view on whether those controls were effective based on the audit procedures that they have undertaken. So you're going to expect the auditor to have that interest in the financial controls. But then what about the other places? The other material controls, so all your operating material controls. And again, you can expect the auditor to look at those and what you're saying about those other controls and their effectiveness based on what they know already from their audit. And just to put into the mix that a substantive audit approach is not indicative of an ineffective control environment. All it simply indicates is that in the auditor's professional opinion, adopting a substantive approach was more efficient in terms of their audit process. So not too much should be read into the fact that there's a substantive audit approach taken. And then the auditor will need to look at the declaration, how they approach that declaration, what controls testing has already been undertaken, what's their understanding of their effectiveness and their view on the effectiveness of those controls that are relevant to the audit. So there's, as you can see on this particular chart, a lot of what the auditor will need to do and process. So if you think about all that auditor process, it's all driven from information that management have provided to the auditor to allow the auditor to investigate more and think about all these various different things. So management do need to be prepared for a different slew of questions in this whole area to support the declaration, which they mightn't have been used to in that particular way. So again, additional time may be needed to make sure that all that work can get done. So it's got implications for timing of audits and all that sort of thing. So having dealt with the Declaration of Internal Control, which very much falls onto the bailiwick of the Audit Committee, we also need to take on board the fact that there has now been, for the first time, an Irish Corporate Governance Code published again last September and applying for financial years commencing on or after 1 January 2025, where you have an equity listing on Euronext Dublin and you're incorporated in Ireland. If you're dual listing, you do get the choice between continuing with the UK code or moving over to the Irish Corporate Governance Code. And again, it's the same comply or explain type approach taken. The next couple of slides, I share with you a document Arthur Cox produced in relation to the areas of divergence between the UK code and the Irish code. I'm not going to talk through each one of these. You will be of interest because of your wider board duty, but they don't actually speak to the audit committee, other than a little bit of a change in language, as you can see from the middle of this slide, where the recent and relevant financial experience has been taken out of the UK code and brought into the Irish code in line with the language that we see in the Companies Acts in terms of competence in accounting or auditing. So it's really language change, but no great change in the actual substance of what's required from the audit committee. In terms of reporting on risks and controls, we don't see a provision 29 coming into the Irish Corporate Governance Code. Instead, we have a provision 30 that says the board should monitor the company's internal control and risk management systems and at least annually carry out a review of their effectiveness and report on that review in the annual report. The monitoring and review should cover all material controls, including financial, operational, reporting and compliance controls. So you can see that's awfully shorter than the provision 29 that's coming in for 2026 that we just looked at. For one thing, there's no declaration here. And for another matter, it is very much speaking to the old 2018 code with the addition of material controls, including reporting controls, which wasn't in the 2018 code. So very much a continuation of what we were doing for 2018 in the Irish Governance Code. Okay, so having looked at that, my last topic to talk to you this morning is on sustainability reporting. And of course, we're interested in both what's happening in the EU and the UK for the most part. In terms of the EU, as you know, the big news story is the omnibus. Looking at this slide now, it's rather busy. In the middle, you have the months and timeline. Above that, you have the Stop the Clock directive. So you can see at the very top line that the Stop the Clock directive was adopted in April, and Q4 2025 is the deadline to transpose into Irish law. But as well as stopping the clock, which meant that people who were to report in 2025 are now pushed out by 2 years, and a great relief, but it means that everybody who's reporting for 2024 onwards stays reporting and doesn't come off that particular treadmill. Then in content of what's to be reported, if you look at the bottom there, you can see that that omnibus package issued in February this year and is working its way through the various different pieces of the trialogue, as they call it, to get to a point where later this year, the negotiations between the European Parliament and the Council of Ministers and the European Commission will start and then hopefully get to a position a little in a year or so where we're looking at transposition and application by member states. So we're still very much in that process. That content and that reduction and all of that is going to actually lead to a huge change. So as you can see, there were 47,000 EU companies going to get caught under CSRD. The omnibus brought that down to 11,700. The European Parliament is suggesting bring it down to about 3,000 companies. And part of the reduction has been achieved by taking the omnibus proposal, large companies with greater than 1,000 employees, to bring that number of employees up to 3,000. So making huge difference. So the omnibus is certainly something that you need to take a little bit of time out to actually understand a little bit better and to see what the implications are for your particular company. And of course, you would be expecting management to produce an appropriate paper. And bearing in mind my remarks earlier from David Ogilvy, hopefully something that's only one page rather than spamming you with a huge overload. And to avoid any spamming and so forth, at the top right-hand corner of the slide here, I've given you a link to a two-page PDF summary from eFrag in relation to what's involved with the omnibus. So if you want to get a quick read, 10 minutes or so, with a lot of detail now, admittedly, on that 2 pages, but gives you a great overview of what's involved with the omnibus. I recommend that to you. And as you can see from the various different things I have in the top of the slide here, you can see that there's remarkable reductions being proposed in terms of the overall length and the mandatory disclosures that are being required. So it's a great thing to say. And in the points below on the slide, I'm just highlighting how they got to make those reductions and the changes that they made. But I do recommend that 2-pager for you to get to grips with the omnibus. The UK has been motoring along, and I suspect there's still an awful lot more change to be seen in the UK. And one thing that I expect to see coming through in the UK, which we actually haven't seen so far, is that the UK will roll back part of, if you like, trying to keep every jurisdiction competitive. That if the EU is only trying to capture 3,000 companies with the new revised omnibus proposals, why would the UK proportionately capture more and give itself a competitive disadvantage? So it'll be interesting to watch how that framework develops. At the moment, they have a part of framework out for consultation, and that consultation is closing or closed at this particular point in time. The main thrust of which is for the UK to endorse for use IFRS S1 and S2, which are the international standards in relation to reporting on sustainability matters. And we expect to see that come to fruition over the next short while within the UK. So I've just given you a couple of slides in relation to all those proposals. And they are, for all intents and purposes, adopting S1 and S2 without any great change. Some reliefs brought in, but nothing that changes the whole of S1 or S2. And as we can see, their next steps is to have it endorsed, get the FCA to take a look at the UK listing rules, and have the TCFD regime that's in the UK listing rules at the moment replaced with reporting under essentially IFRS S1, S2, but as adopted and endorsed into the UK, which is only about 4 minimal changes between the 2 documents. So for all intents and purposes, they are bringing in IFRS S1 and S2 into the UK. We have a need to know in relation to all that's been discussed, and I have it linked there on the last slide. If you're on an audit committee where you think UK sustainability reporting standards will be of an importance to you. And again, referring back to our corporate reporting insights series, which I mentioned earlier when we were talking about financial reporting, we have covered off some of what we've seen in terms of the climate reporting in UK companies, and a summary of the results from those insights on this particular slide. So if you are in preparation, we have a number of different actions that we think an audit committee should be directed to think about taking in relation to it. I'll leave them set out on that slide for you, and do feel free to share these with management, including encouraging to take a look at the various different links that are on this particular page. So with that, I'd like to invite any questions in terms of all that we've spoken about for
one question in the Q&A, Oliver, that came in earlier on, just in relation to what would an internal control weakness actually look like?
Colm, I think you're more in a place to report internal control weaknesses because that's your bread and butter.
Yeah, no, no, no. And I think in relation to it, I think it is going to be looking at the materiality, and it's not again back to the financial materiality. It's the impact of the control weakness in relation to the performance of the business or the performance of that area of the business is going to be that is material control. But I think it is always back to how the audit committee and indeed the board get comfortable in terms of definition in around that and define that in advance so that there's in a proper manner, that it's not too tight that you're wrapping yourself up in string, but something that it is in a position that that the audit committee and the board can be comfortable on, or the risk committee indeed if one exists. So I think it goes back to where appetite is breached, where near miss as well, I think is also important to consider in how one might write that paper and manage that.
And I fully concur that difference between quantitative materiality and what's regarded as qualitative materiality. And I suppose boardrooms have seen a lot of behavior from, let me just say, senior people, where that behavior might be tolerated at a lower level in the organization, certainly not tolerated at higher levels. And therefore, a lot of the circumstance about what you're looking at and everything needs to be put into context. And going on from behavior to actual business and parts of the businesses, there are areas of business where, and even within areas of business where there are activities taking place, and the qualitative nature of those activities might get you to materiality far quicker than other areas. A case in point might be where you're dealing with an area where corruption comes to the fore of a public official or something of that nature, that even though that amount of corruption might be, let's say, in an immaterial amount, the fact that it was to a public official and that whole context would make it very much material. So again, all those particular areas all needing to be thought about in terms of what's material control, because I would imagine modern slavery or any foreign corrupt practices and all of that, quantitative materiality possibly doesn't come into it. It is just simply qualitatively those areas make everything material.
And then Oliver, there's another question has come in is, do we see a CSRD light coming in if obviously the bar is being lifted, if that's the correct terminology for that?
It's an interesting one. I think we'll see that whole omnibus process working out, and I think the trend is to a lesser detailed regime than the regime that we started out with. I think the EFRAG have brought out a voluntary statement for SMEs, and I think that you'll see that as been the lowest bar, and everything is built above that particular bar. I think it's also very useful in the sense that a larger company in the value chain looking to report can't ask a smaller company that's an SME for anything more than what's in that voluntary standard. And I think that's a very useful check to have in place. And it also gives a very good starting point, because at least if your organization is meeting that voluntary standard, you know you're in a position to meet the kind of information criteria that might be required of you. And then as you get caught more into the CSRD regime, because you're wave 2 or wave 3 or wave 4, you'll just ramp up to meet all of that.
Excellent, Oliver. We're hitting the top of the hour. Thank you very much. We will be sending out the slides, which will include the links to the areas that Oliver mentioned, and obviously some of them are available on your iPhone and your iPad, and others now you can take with you no matter where you are, and review at any time. Oliver, thanks. It's always a pleasure, and take care, everybody.